Do you feel like there's something missing from your investing strategy? You might be surprised to learn that it's a secret that the big brokerages are trying to deliberately keep from you. Less than 10% of investors outperform this strategy, and I want you to join those elite few who are on their path to financial independence. This isn't some kind of marketing funnel. I'm not trying to steer you to my ebook. I'm just trying to share with you the lessons I've learned from years of trading. And this secret is a game changer. And I have the data to prove it. Let's get into it. So let's start by talking about Warren Buffett, the Oracle of Omaha. So he's routinely renowned as the best fundamentals investor of all time. He runs Berkshire Hathaway and he's made billions upon billions of dollars for all of his investors. Now let's meet Ted. Ted Seides was the chief investment officer and president of a hedge fund called Prodigy Partners, and he is successful in his own right. Warren and Ted made a bet. So Warren bet Ted that over a 10-year timeline that he could outperform his hedge fund with a very simple investing strategy, just buying into an index fund. So they made this bet in 2007. So right before the market collapse that happened in 2008. So you would think that Warren Buffett would get destroyed by this hedge fund manager, but that's not what happened. After the market downturn of 2008, the stock market made a very strong recovery. And because of the difference in fees between the index fund that Warren Buffett and the hedge fund manager were charging, Warren Buffett stormed ahead of the hedge fund manager. And before the 10-year bet was up, 2 years before it was about to end, the hedge fund manager actually conceded and acknowledged that Warren Buffett was going to win their bet. It's truly amazing what the power of time and compounding can do to a portfolio. But what is an index? So an index tracks the stock price of a group of companies that have some common features. And there's quite a few indexes that people will refer to, but some of the big ones are the S&P 500, which is all the top 500 companies in the world. The Nasdaq, which is a tech-focused index. And a lot of people like to focus in on the Nasdaq 100, which are the top 100 tech companies of the Nasdaq. And then there's the Dow Jones, which is one of the oldest indexes that has ever existed. And it's just a collection of 30 US companies. And then there's the Russell 2000, which benchmarks the US smaller cap, small company performance. So you might be wondering, why don't the big brokerages want us to know that index fund investing can outperform active management? And you also might be wondering, how is it even possible that Warren Buffett was able to beat a hedge fund manager by using such a simple strategy? And the answer is the same thing: fees. So if you have active management, then you have a larger expense ratio than if you use an index fund. And an expense ratio is just the amount that they charge you every year on the funds that they have under management. So it's a percentage of the funds that they are managing for you that they are taking in fees every single year. And these index funds have extremely low expense ratios. And that was one of the big drivers on why the performance for these index funds is so much better than active management. But it's also why the large brokerages don't want you to know that you can get better performance with lower fees. Because if they charge you less money, they make less money. So they want you to pick their active management or pick their target date fund and not use this passive strategy that will outperform them. So I'll leave a link to this calculator in the description down below. But I'm going to illustrate for you why fees are so important to consider over a 20-30 year timeline for your retirement portfolio or any portfolio in the stock market. So for the purposes of this example, we're going to assume an initial investment of $10,000 and future plan contributions of $4,959 per year. And you're like, that's a weird number, but I'll show you why I picked it at the bottom. And then we're going to assume you invested over 30 years, which is, a standard working career. And you're going to get a rate of return of 9.67%. I picked this percentage because that is the percent return you would get every single year over the last 30 years if you invested in the S&P 500. And then the fund expense ratio I'm going to pick is 1.1%. So 1.1% is the active management expense ratio that you would see if you use active management at Fidelity, Edward Jones, and some of these other financial advisors. So if we calculate, you can see that the ending value that you have with fees included is $795,000 of the $1 million that you were supposed to have. So over this 30 years, you spent almost $200,000 in fees having an active manager. So you're like, okay, well, I don't want to use an active manager. Maybe you're like, I'll just use a target date fund, the other product that a lot of these big brokerages will try and sway you to. So the expense ratio for most target date funds is around 0.49%. So let's calculate that. So you can see that you're still spending almost $100,000 in fees. So you get $900,000 of the $1 million that you should be getting from your investment. And you're like, oh, that's better. I mean, you cut your fees in half. But when you compare that to an S&P 500 index fund, 0.02%. So these are the fees you can expect to pay on an S&P 500 index fund. So let's calculate here. You can see that over a 30-year timeline, you're only spending about $4,000 in fees, and you get almost your entire $1 million. Not to mention that with that active management and with that target date fund, your returns aren't actually going to be this 9.67% because they mix in bonds, they mix in equities from other countries, emerging markets. The performance is not this 9.67. So not only are you paying more, you're getting less money at the end. And this is why Warren Buffett was able to beat the hedge fund manager. So you might be thinking, do I need some sophisticated investing tools in order to use this strategy? And the answer is absolutely not. You buy into these index funds and you don't have to change at all, ever again. So all the active managers actually compare their performance to the S&P 500. The S&P 500 is the benchmark that they use to gauge their performance. So I'll show you the most common S&P 500 index funds for the large brokerages: Fidelity, T. Rowe, Vanguard, Charles Schwab. So these are the ticker symbols for those S&P 500 index funds that you should buy in your retirement account or your taxable brokerage. And that's it. That's all you do. And you're like, well, that's too simple. Why doesn't everyone do this? It's because it's boring. It takes a really long time. And you have to be patient and willing to ignore the news cycles of bear markets and recessions and bull runs because of AI and the latest fad. You have to turn the FOMO off and do the boring thing for 20 to 30 years and just not look at it. And most people are not willing to do that. So you might be wondering, does this S&P 500 index fund investing strategy work in our current market environment? So if you look at the graph for the S&P 500 over the last 30 years, the index started at about 1,000 and now it's at 5,000. So from 1994 to 2024, you would have 5x'd your money if you just put it in the S&P 500. And there are a bunch of highs and lows. A lot of things have happened in the world between 1994 and now. 9/11, we were at war for almost 20 years in the Middle East. The stock market crashed from the dot-com bubble. It crashed again in 2008 with the housing market. And we had a very long bull run. But with all the volatility, all those different market conditions, you still got a 5x return over the last 30 years by employing this very simple strategy and ignoring the noise. So you might be thinking, there's no way this strategy is that simple. So let me give you a glimpse under the hood of my personal investing. So I didn't really discover this strategy until after I left the Navy in 2014. And we didn't really start tracking our financial performance until about 2015. So if you look at our mint in 2015, October of 2015, we had about $120,000. And then from 2015 to now, I've been using this index fund investing strategy. And you can see as of February 2024, our investments have grown to $591,000. So this is a huge return. And you might be thinking, well, this math is more than 9.76% that you were saying the S&P 500 returns in a given year. And I'm going to tell you the secret sauce that I have to improve this index fund investing strategy. So this website is actually one of my favorite tools to analyze any portfolio that you're planning on investing in. And for the purposes of this example, we're going to be investing $10,000 from 1994 to 2024. And we're going to invest all our money in the same index that Warren Buffett used to beat his hedge fund manager. This is the Vanguard 500 Index Admiral. So it just tracks the S&P 500, and we're going to put all our money into this index. So if you analyze this portfolio, you can see that your $10,000 investment with no additional contributions is $56,000 at the end of this 30 years. So the secret sauce is dollar cost averaging. So dollar cost averaging is just a system of buying a fixed dollar amount of a specific investment at regular intervals. So this happens all the time with your retirement account. Every 2 weeks, whatever you say you're putting aside is going to get automatically invested. But you can use this same strategy in a taxable brokerage outside of your retirement account. So I like to use M1. It allows you to automate this whole process. So the money goes in at fixed intervals and you don't even have to think about it. So the biggest benefits of this dollar cost averaging is that it builds the habit of investing and paying yourself first the same way you pay a bill. It also eliminates any emotion you might have about buying or selling or moving your money around. It takes all of that out of it. It prevents you from only buying when the investment is at its peak. So left to your own devices, most people buy investments when everyone else is buying investments, and they sell investments when everyone else is selling investments, when you should actually be doing the opposite. I think Warren Buffett said you should be greedy when others are fearful, and fearful when others are greedy. And if you do this dollar cost averaging strategy, you take all that emotion out of it. You're buying when it's high, you're buying when it's low, you're just buying at set intervals, and you aren't even thinking about it. So if we go and we contribute a fixed amount, so let's say $400, and we do it every month. And I picked this amount because a lot of employers have a 3 to 6% match on their 401k. And it's not a big stretch for that 3 to 6% match to be very close to this $400 a month number, or even slightly more than this $400 per month number, depending on what your compensation is. But it's a reasonable amount that you can achieve. So if we analyze what happens if we actually start dollar cost averaging into our strategy, you can see that our $10,000 investment is actually $600,000 now, as opposed to that 50 that we were getting if we didn't keep contributing. So that is a huge difference. And you're like, okay, that's great. So dollar cost averaging is part of the secret. And here is the huge secret that I've been using in my personal retirement account. So the S&P 500 has all the top 500 companies in the world, but in the last 20 to 30 years, most of the growth in the US is coming in the tech sector. And it's not hard to see that with AI and the rise of robotics and the rise of electric cars, there's going to be even more growth in the US from tech. So I actually started purchasing a Nasdaq 100 index fund. So let's see what that looks like. So QQQQ is an index fund that tracks the Nasdaq 100. Let's see what QQQQ will do across 30 years. And you can see that in that same 30 years, QQQQ actually returned $1.1 million if we employed this dollar cost averaging strategy with investing in the Nasdaq 100. And that is what I've been doing in my taxable brokerage outside of work and in my retirement accounts, because I believe that tech is going to lead the economy forward for the next 10 to 30 years. That's the secret sauce, guys. Consistency and boring investing in the same thing for a long period of time. So you can ditch those advisors who are trying to charge you 1% of everything you have under management and just do this.
Of all the things that have happened since 1942, we've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars, we had 9/11, we had the Cuban Missile Crisis, we have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million now.
If you still have questions on whether you should be investing in a Roth retirement account or traditional retirement account, I have a more in-depth conversation about the tax benefits of each and who I would recommend investing in a Roth or traditional, and at what point in your career I'd recommend investing in a Roth or traditional, in my previous video discussing how to lower your tax bill. And you guys can check that out. So if you learned something today, if you're excited about securing your financial future from the things I shared with you in today's video, please like and subscribe so other people can find this valuable information and get on that path to financial independence and empowerment, just like you. Thanks for watching today, and I'll catch you next time.